cash. So this still we are doing that is accounting for assets and liabilities, accounting for assets and liabilities. And yesterday we looked at the property, plant, and equipment. So today we are looking at cash in hand, cash in hand, and cash at bank, and cash at bank. In brackets, they are indicated bank. In brackets, they are indicated bank reconciliation. In brackets, they have indicated bank reconciliation. They have indicated bank reconciliation. Indicated bank reconciliation. So me, I always teach as per the syllabus. I always teach as per the syllabus. So if you see anything which jumped in the syllabus, then it means it's not coming in exam, but later we can learn it for the purpose of understanding. But this time, let's focus mainly on exam because we only have 3 months to do exam. But when it comes to the time of revision, then you can see all of them. So now we are looking at cash in hand and cash at bank, cash in hand and cash at bank. All these are assets. All these are assets. So what are the reasons? So we need the reasons of what? The reason for bank reconciliation. So why do we do a reconciliation? We do a reconciliation to update our books with bank, to update our books with bank. So basically, this one is reconciliation for bank because it is cash in hand at cash at bank. So it is not the reconciliation of suppliers. It is not the reconciliation of suppliers. It is specifically bank. So why are we doing this reconciliation? So that the bank, so that we update our books with the bank. Remember, cash is a critical asset in a company. Is a critical asset. So what are the items bring this bank statement and the cash book statement not to match? So we have some items which make this cash book and the bank not to match. So some of the items order, these are standing orders. So what is the standing orders? Standing orders ni ile orders the company give to the bank so that the bank can pay without the knowledge of the company, without the knowledge of the company. So long as the bank has the previous instruction from the company to pay this one without the knowledge of the company, then when it reaches that time, the company initiates that transaction automatically. So if the bank initiates that transaction automatically, it means it is reflected in the bank books, but it is not reflected in our books. So that's the one item which brings the variance. That is the one item which brings the variance. That is the one item which brings the variance. Another item is what? What the bank charges. Another bank charges. Another is bank charges. Bank charges is that you will not be able to view any charges when you transact with the bank. If you receive any payment from the bank or you do RTGS or cash withdrawal, there is charges. These charges you will not be able to account on daily basis. What you do, you just wait at the end of the month when you receive that statement, then you can now account for these bank charges. So these bank charges, it is already in the bank, but it is not in our books of account. So we need to update them. Another one, direct deposit. So that when we say direct deposit, this is the payment which the customers made directly to the bank. So it made directly to the bank. So it means it is in the bank, but it is not in our book, not our book. So these are the some of the few items which will cause this bank and cash book not to balance. Not to balance. So what are the steps of preparing the bank statement? So the steps of preparing bank statement, is to have the updated cash book. So you have to update your cash book first. Always the bank, don't update the bank, don't update the bank. So we normally update our cash book. So you have to open to what is called updated cash book, which you have the balance. This is balance as per our book, as per our books, as per books. So you have to get the balance as per books. So this balance as per book, it can be negative. Yeah, it can be balance as per books, balance as per book. Then we have this standing order. The payment, have to credit our books. We have to credit our books. Remember, it is there. We are reducing the asset, which is cash. We are reducing the asset, which is cash. So we have to credit. We say, whenever a decrease in asset, you do what? You credit. Whenever there is a decrease in asset, you credit. And then we have bank charges. Bank charges again is an bank charges again is an you have to credit. Bank charges again is an expense. You have to credit. What else? What else? What else can we have here? We have dishonest. We have dishonest check. We have dishonest check. When you say dishonest check, is the check that you take to the bank, but the bank rejected. Either maybe the date is wrong, the account is wrong, the name is wrong. So it might be due to so many reasons why the bank has rejected that check. So if the bank rejects that check, it means you have already received this check in your books or debit side as that you have received money. Now the bank says this check will not go through. So you need to remove it from your cash book by doing what? By crediting. So you write dishonest check. Those are just few items which we can pick, but when we go to the illustration, we see so many items. So here you will have the balance. You will have think it will be so it's either way. You don't know which side it is, but you have updated. This one will be updated balance, updated balance, updated balance. Updated balance to close that account. So that is the first step. That is to open the updated cash book. Is to open the updated cash book. Is to open the updated cash book. Make sure you write down this. Write down this. Sure you write down this. Make sure you write down that. Then you can ask. So we have so once you got this updated balance, then we have to have the bank reconciliation. So then we have to have bank reconciliation. That is step 2. So the bank reconciliation as of this date, as of this date, as of this date. Then you get your balance as per updated cash book, updated balance as per updated cash book. balance as per updated. We have to add back. You find that there's check which are unpresented check. There's check which we have it, that check in our company or in our cash, what do we call it, cash lock? Yes, there's cabinet in our cabinet, maybe where you keep the check you receive, but we have not presented this check to the bank. We have not presented this check to the bank, and you have already received in your ledgers. You have already received your ledgers. So what we do, we add back and present, add back and present check. We add back and add back. So this unpresented check, most of the time it is for suppliers. Most of the time it is for suppliers. Maybe you are paying certain suppliers, but you have written the check, you have booked in your ledgers, either QuickBooks Sage or whatever you are doing as an accounting system, but you have not taken this check to the bank so that they can debit your account. So that's why back. That's why we are adding back. Then you need to less uncredited, uncredited, uncredited check, uncredited check. So you need to learn uncredited check. So that at the end you get the balance as per bank statement, balance as bank statement, balance as bank statement. So why are we lessing uncredited check? Why are we less uncredited check? The customer has taken check to the bank, or you yourself, you have taken your check to the bank, which is the check from the customer, but the bank, they have not credited your account. The bank, they have credited your account. So we need to less, because that amount has not been related. You need an income, and this one, but it can be. It depends with the nature of the transaction. Depends with the nature of transaction. So that is all. That is all. Even if you go to the practical fields, this is what we normally do. Nothing will change. Nothing will change. Nobody are new for practical experience. This practical experience is now how do we put this one, but the knowledge will remain the same. The knowledge will remain the same. In fact, what accountant does is just financial accounting one. It's just financial accounting one, because anything else remains for the auditor. If it is the final statement, then that one will go to the auditor. So the main thing for you is to understand this. The main thing is to understand this. Think of all those financial reporting. That one is for auditor. It's not meant for you, so long as you know how to account for this one. Because at the end, you are given out a draft account to the auditor. The auditor will ask you, give me the bank reconciliation for all the period from January to December. So you have to give out this bank reconciliation, which is very important. It's very important. So we can have now the illustration. I have so many illustrations here. I don't know which one to start with. We have November 2015. We have November 2015. So the question here, 2015. We have November 2016. We have November 2016. And then for 2020, I think there's for 2020. And there's another one here, which I don't know it is for which period, which is, I think it is 2017. To check for 2017, either December or November. 2017, either December or November. So we can start with this November 2015. We can start with this November 2015. And I hope you are able to download it from the link. You can't manage to the group. Let me check the snapshot. And 2016 again, and 2016. Evelyn say no audio from your side. Have you? Is it okay now? Maybe you have not joined with audio. Okay. So check you are not able to download the past paper from the link. Take time to check the WhatsApp group and look for the question. Look for the question.